Okay, next entry. So we're going to go see what number 5 was. We took care of number 4. Number 5. On March 31st, Harris calculated $2,200 of interest expense incurred on its mortgage. On March 1st, Harris paid the bank $1,000, with the balance expected to be paid on April 30th. Okay, so what do we have? Well, we have interest expense. Expense is a income statement account, increases with a debit. Expense increases with a debit. We also have a cash payment of $1,000, and then the difference is expected to be paid at a later time. So let's go back over here. We're going to have a debit. That debit is going to be to what? Interest expense. And the amount was $2,200. And it said that we paid cash. We know that cash is an asset. Asset decreases with a credit. Asset decreases with a credit. So we're going to decrease that asset cash by the $1,000 that was paid, and the difference is $1,200. We know that's going to be the other side of the credit because the debits and credits have to be the same. And what do we have here? Well, we didn't pay all the interest yet, so we have a liability to pay later, right? A liability increases with a credit, so that looks correct. Liability called what? Interest payable, right? It's a payable for whatever is relevant in the problem, right? So this is interest, so this is an interest payable. All right, that's number 5. Let's go to number, by the way, we have forgotten to say, are these accruals? Was this an accrual right here? Well, we recorded $2,200 of interest expense. We paid some of it in cash, but we didn't pay it all, right? So there was an income statement entry here for this expense that was different than when the cash moved, $1,200. So we accrued $1,200 of interest here. So yes, that is an accrual. What about this one? We forgot to do this one up here. Factory is an asset. Mortgage payable is a liability. Is there any income statement account? No, not an accrual. All right, now let's go to number 6. Number 6, on January the 30th, Harris purchased machinery for $10,000 with a note. The equipment has a 5-year life. So we got machinery, we gave up note. So the entry is going to be debit machinery. Machinery is an asset. I'm just going to call it equipment because it's a general bucket. We could put other things in there as well besides machines. Equipment, that's an asset. Asset increases with a debit. The amount of the machinery was $10,000, so we're going to put it here, $10,000. We know the other side has to be $10,000 also. And what is that going to be? Well, we didn't pay cash. We took out a note. We financed it, so that's note payable. Is there any income statement account here? No, that's an asset. That is a liability. Liability increases with a credit. No income statement account. That is not an accrual. Okay, it's a journal entry. It's an entry, but it's not an accrual. We're not accruing anything right there. Okay, number 7, on February 16th, Harris purchased inventory on account for $5,000. So what did we get? Inventory. Inventory is an asset. Asset increases with a debit. What did we give up? Well, on account. So on account means we didn't pay cash. We financed it. Or we, in the normal course of business, when you purchase something small and recurring like inventory, it tends to just go into an account called accounts payable. Accounts payable for the amount that you're going to pay later. So we bought inventory and we have an accounts payable. Accounts payable is like a catch-all bucket if you don't have another payable specific to the item. Inventory is one of those things that turns over and over and over and tends to go into a catch-all bucket called accounts payable. That's what you're going to see in your accounting classes. $5,000 was the amount. So let's go back over here. We're going to put $5,000 in for the debit as well as the credit. Is this an accrual? Well, there is a payable involved, but did I hit the income statement for anything? Did I accrue any expense or any revenue? No, that's an asset. Inventory is an asset. That is a liability. There's no income statement account here. So we do have a payable to pay some cash for this inventory, but we haven't accrued any revenue or expense. So no. This is not an accrual. All right, number 8. On February 27th, Harris sold goods to customers on account for $6,000. The cost of the items were $2,500. All right, so we sold goods. That sounds like what? Like revenue, so sales revenue. And on account means they didn't pay cash, so we sold on account. That would be what? That would be accounts receivable. When you're dealing with inventory, it tends to be accounts payable when you purchased it but didn't pay in cash. Accounts receivable. Inventory is you're in this business of churning inventory over and over and over, so there isn't a separate specific payable and receivable to that. It goes into the general bucket called accounts payable and accounts receivable. So in this case, we sold our inventory, we sold our goods to customers for $6,000. So what do we have? Well, we have sales revenue is the first thing, and that is $6,000. Revenue is a income statement account. Revenue increases with a credit, so we credit that for $6,000. And they didn't pay in cash. They paid on credit. So we have accounts receivable for the same amount. Is this an accrual right here? Well, did we hit the income statement? Yes, we hit the income statement with sales revenue. Did they pay in cash at the time of the income statement entry? No. So we put up an asset called receivable. Asset increases with a debit. So yeah, that is an accrual. All right, but there was another part of this entry, wasn't there? The cost of the items sold were $2,500, right? Cost of the items sold, meaning the cost of goods sold. That is a term you're going to start to hear a lot in your accounting classes. Cost of goods sold is an expense. That is the cost or expense of what you sold. So expense increases with a debit. That was cost of goods sold increasing. So we're going to put cost of goods sold right there. The amount was $2,500. And what did we sell? Well, we sold our inventory. Okay, so inventory is an asset. Asset decreases with a credit. So we're going to take inventory off the books in a value of $2,500. So that was a two-part entry right there. This was accruing the sales revenue, and this was taking the inventory off the books. Is this an accrual right here? Are we accruing something before the cash moves? No, because this inventory was already purchased a long time ago. So technically, this is not an accrual. It does have an income statement account in there, but just because it has an income statement account doesn't mean it has to be an accrual. The reverse is always true, though. If it is an accrual, then it does have to have an income statement in there somewhere. Okay, this particular one is not an accrual. Being an accrual or not an accrual is not a good or bad thing. We're simply trying to identify, for your understanding, what is an accrual, what is accruing something, and what is just a journal entry. Okay. Number 9. On March 1st, Harris retained the legal services of EFG Law Firm. The services are to be provided for 2 months between March 1st and May 1st. The agreed upon fees are $10,000. As of March 31st, half the services have been appropriately provided. So, on March 1st, they retain the services. Is there any entry there? No entry, because we already talked about when you enter some kind of contract or arrangement to provide services or to receive services or to do anything, when you actually sign the contract or enter the agreement, nothing has actually happened. There's no accounting event happening right there. So there's no entry on March 1st. On March 31st, half the services have been provided. The contract is for 2 months between March 1st and May 1st. Okay, so March 31st is halfway there, half the services. So 5,000 of, it doesn't say anything about cash being received here, does it? So if it doesn't say anything about it, we have to assume that no cash has been received. Therefore, we have to accrue What do we have to accrue? The expense, right? Where this is an expense. We retain their services. We have to pay them. We owe them this $10,000 over the 2-month period. No cash has been paid yet. So as we close the books on March 31st, remember what we're doing here is we're closing the books for the quarter ended March 31st. That's why it says do all of the things that we talked about in the instructions here that we're starting to go through and will continue to go through throughout this problem. It's all about the quarter ended March 31st. Okay, that's what we're working on right now. So we have to close the books and we have to record something even though these services aren't complete. Half of them are, and the books are closing. So on March 31st, we're going to record 5,000. I'm just going to put the 5,000 in here. We know there's going to be a debit and we know there's going to be a credit and we know it's going to be for 5. What are the entries going to be? There was no cash. Well, we have legal fees. That's an expense. We could write legal fees expense if it's clearer. Either way is fine. Legal fees is an expense. That's an income statement account. An income statement account, expense account increases with the debit. So we increased the incurring these fees. And what is the other side? We didn't pay cash, so it's legal fees, what? Payable. Legal fees payable because we didn't pay the cash. So is that accruing legal fees? Yeah, that is accruing legal fees right there. We put up an accrual for legal fees. Number 10. On March 1st, Harris rented a temporary storage facility for $1,500 a month with payment due on the 1st of each month starting in April. On March 31st, the accountant prepared the rent check to be mailed the next day. Well, that's nice that it's going to be mailed the next day, but we need to figure out what's happening on March 31st. No cash was paid if the check is not going to be mailed until the next day. So what do we have to do? We have to accrue. What are we accruing? We're accruing rental expense for a temporary storage facility. So rental expense is an expense account. It's an income statement account. Expense account increases with a debit. Rental expense. And we didn't pay cash, so what is the other side going to be? Rent payable. All right? And we're going to put $1,500, I believe the amount was, right there. $1,500 credit. Okay? And number 11. Did I answer this question? Yes, that was an accrual. We know that's an accrual. We're accruing rental expense. Next one. On March the 2nd, Harris purchased a patent from a former competitor for $8,000 cash. So what did we get? We got an asset called patent for $8,000. And what did we give up? In this case, it says we gave up cash. So we're going to put $8,000 credit. Cash is an asset. Asset decreases with a credit. Patent is an asset. Asset increases with a debit. Is this an accrual? No. There's no income statement account here. That's not an accrual. On March 3rd, Harris purchased $6,000 of Microsoft stock. Harris intends to hold the stock for more than 1 year. So what did we get? Stock investment. We invested in stock. And what did we give up? We gave up cash. It doesn't say that, but you don't purchase stock with anything but cash. So that's kind of implied in the problem. Stock investment. A stock investment is an asset. Asset goes up with a debit, and we gave up cash. Cash goes down with a credit. The amount was $6,000, and the amount here was $6,000. So if we look over our general journal here, we have filled out our general journal. We know that that was not an accrual, the stock investment for cash. There's no income statement account. So here's our general journal. We have finished the process of completing our general journal. Here's all the journal entries that were relevant to the quarter ended March 31st, 2022. Now, what is the next step? Well, we have to post the journal entries to the general ledger. That is the next step in the process. The general ledger is right here. If you recall, what is a general ledger? Well, it is the place where all of the individual accounts are located. So here is every account on the company's books. These are set up as T accounts. Remember, T accounts just look like a T, debit on the left, credit on the right. every account that we need is listed here in the general ledger. And so what we have to do is we have to post all of these journal entries to the ledger so that we can organize and summarize the data. Right here in this format, the general journal format, it's very hard to see what's going on because each journal entry, they could have multiple hits to the same account. Here you have a cash hit, here you have a cash. There's a lot going on here. Very hard to summarize. So the next step is to put it in the general ledger. So the process of doing this is very simple. You just go through. We're going to find the different accounts. I'm going to put debit to cash right there. Common stock is a credit of $30,000. Note payable is a credit of $20,000. Number 2 was no entry. Number 3, we have a debit to cash for $15,000. Revenue receivable. Right here, receivable is an asset. Services revenue. Let's go down here to find services revenue right here. With a credit, we're going to link it right over there. Did I get all of the entries in there? I got in the 15, I got in the 25, I got in the 10. So that balances. Factory, $40,000 asset, increases with a debit. Mortgage payable, credit. Interest expense, $2,200. Let's go down here, find interest expense account. That increases with a debit. Expense increases with a debit. Cash is going down for the payment, if you will recall. So we're decreasing cash with a credit. This is the payable. Payable is a liability for that interest, for the portion that we didn't pay. That increases with a credit. Equipment. Equipment is an asset. Asset increases with a debit. There's a note payable right there, another note payable for $10,000 for the equipment. Inventory, increase with a debit. Accounts payable, increases with a credit. Next one, accounts receivable, $6,000. That increases with a debit. Sales revenue, right here, increases with a credit. So if you were doing this on an exam and you had a bunch of journal entries, right, and they said post them to the ledger, this is what you're going to do. You're going to take each one and you're going to put it into these T accounts by debit and credit so that we can summarize all this information. Where did we leave off? Right here with the $6,000. So cost of goods sold, that's an expense, increases with a debit. Inventory went down with a credit. Legal fees expense, that's an expense right here. That increases with a debit. The payable, because we didn't pay it in cash, increases with a credit. Rent expense, expense increases with a debit. The payable, that's a liability, increases with a credit. Patent, that is an asset, increases with a debit. Where was I? Patent, cash. Wait a second. Hold on, I typed in the wrong one. Rent payable, rent expense was the 15. Patent was $8,000. There we go. The other side of that was cash. Go up here. We're going to enter the cash side. And finally, stock investment. Investment is an asset, increases with a debit. We paid cash. Cash decreases with a credit. And that was the process of posting. The word is posting. When you're told to post the journal entries to the general ledger, that is what we just did. So now we have all of the balances right here in the general ledger in their accounts. Now what's the next step? Well, if you recall, we're going to have to summarize these accounts. So if there's more than one entry in these accounts, we're going to put a line right here to show that we're going to do a calculation. Most of them in this example only have one, but there's a couple of them that have more than one. So if there is several like this, the first thing we're going to do, in any T account, you're going to sum up all of the balances like this. I'm going to sum up both sides. Then I'm going to put another line here to show we're doing a calculation, and I'm going to take the larger number, and I'm going to subtract the smaller number, and that is going to be the balance in the account right here. So it was $65,000 in debits. There was $15,000 in credits in this account during the period ended March 31st, 2022. So there were 65 debits, 15 credits. The cash account has a debit balance of $50,000. The accounts payable has a credit balance of $5,000. If there's only one, there's nothing to really add up. Okay, accounts receivable has a debit balance of $6,000. This one has two, but they're both on the same side, so I'm just going to sum those two up right there, and we don't have to subtract anything because there's nothing on this side. So that's going to be our balance right there. This one, 25. This one, this one, this one, this one. Those are all going to be our balance because there's nothing else in there. In fact, all of these right here, I'm just gonna highlight each of one of these, and every one of those is going to be our balance because there isn't anything else in there. This one, there's only one number on each side, so I'm going to take the larger number, 5,000. I'm going to subtract off the smaller number, and the inventory account has a debit balance at the end of the period of $2,500. Oh, and we got this one right here with the patent. So the next step in the process, after you post the journal entries from the general journal to the general ledger, now that they're posted and summed up, so we know what the balances are at the end of the period. That's what we just went through. We figured out the ending balance in every account. The next step is going to be prepare the pre-closing trial balance. So recall what a trial balance is. A trial balance is going to be two columns. One column has all your debits in it. One column has all your credits in it. We're going to put all the debits from these accounts, all the debit balances from the general ledger. We're going to put them in here. Then we're going to put all the credits on this side. Then we're going to sum them all up, and we're going to see if they balance. If the debits and the credits right here do not balance, then we know we have a problem, and we have to go back and figure out where the problem was. So I'm going to start right here. I'm going to grab cash. The cash balance is $50,000. I'm going to grab accounts receivable. I'm going to grab revenue receivable. Those are all debits. I'm going to grab inventory and put it right over here in my trial balance. I'm going to grab stock investment, $6,000. I'm going to grab factory, $40,000. I'm going to grab equipment, $10,000. What's next? Patent. I'm going to grab that. That's $8,000. What's next here? Accounts payables. Oh, so that is a credit. Accounts payable is a liability. Liability has a credit balance. So I'm going to move over to the credit side of the trial balance. I'm going to grab accounts payable. What's next on here? Interest payable. Let me go down and find that. Interest payable has a credit balance there. Legal fees payable. Let me grab that one. Rent payable. Credit. Put that in the trial balance. Note payable. Where's my note payable? $30,000 right there. Mortgage payable, $40,000. Common stock. Where's my common stock? Right here. Credit of $30,000. What's next? Retained earnings. There is no retained earnings yet, so I'm going to put 0. There will be retained earnings at the end of the period because we have income and expense items to determine what our net income is to close out to retained earnings. But since this company just started, there was no balance in retained earnings at the beginning. So retained earnings is 0. Next one is revenue. Revenue increases with a credit. So right here, $25,000 of services revenue. We have $6,000 of sales revenue. Cost of goods sold, that's an expense. Expense increases with a debit. So I'm going to move back to the other side of the trial balance, grab my cost of goods sold. Next, legal fees, debit. Next, rent expense, debit. And finally, interest expense. There we go. Now, I already put the summation in here, so it added up automatically. Let's see what we got. We have $143,700, and we have it on both sides. That means the trial balance, the pre-closing trial balance, is balancing. So let's make sure we understand what we did. We took so far, we're not done, but what we did so far. We took all of these various financial transactions. This is the accounting process, so make sure you're following. We took all these financial transactions. We recorded a journal entry in the general journal for each one. Once that was complete, we took each entry and we posted it to the general ledger. The general ledger summarizes everything by account so we can figure out what the balance is at the end of the period. After we put it in the general ledger, then we came over here to the trial balance. The trial balance is where we test to see that the general ledger is balancing. And in this case, it is. So we have that covered. Now, the next thing it asked us to do is to determine for all of our balance sheet accounts. Let me go back to the instructions and see what it asked us to do. For all balance sheet ledger asset accounts, identify the account as a current asset or a non-current asset and categorize it as current, long-term investment, fixed asset, or intangible. And then for the liabilities, current versus non-current. Assets tend to be broken out into more categories. Liabilities tend to be grouped just between current and non-current for the most part. If you have a lot of liabilities and grouping them would be helpful to your financial statement users, it's not unheard of that it could be, but for now we're just going to keep it simple with current versus non-current. So we're going to go through this right here. Here's all the assets. First we're going to classify them by duration. Duration is current or non-current. And before we do, let's just see where I wrote that down. Here we go. What is current assets versus non-current assets? Current assets are those that are expected to be realized, used up, recovered, or to turn within 1 year. What does it mean to turn? Well, think about inventory. When accountants talk about inventory, they say inventory turns, meaning you buy it, you sell it, you buy it, you sell it, you buy it, you sell it. It keeps turning over, and that's what that means. So inventory is something that is expected to turn in less than a year. Realized, used up, recovered, those are other terms that will be utilized for the in relation to assets that are supposed to have a duration of less than 1 year. Also, those that may not have a duration of less than 1 year per se, but they're highly liquid, like cash would be the obvious one. Also, stock or investments in stock, as long as the company doesn't intend to hold those for more than a year. If they do intend to hold them for more than a year, then those would be considered non-current. Okay, so let's go through the list here. Cash, current, we know that. Accounts receivable, current. It is generally expected that you would collect your receivables within 1 year, so that is current. Revenue receivable, current. That's your business. You're in the business of generating revenue. It's expected you would collect that within 1 year. Inventory, the same. It's expected we would collect that within 1 year. Stock investment. Now, stock investment could go either way, but remember, over in the problem over here, it said Harris purchased the 6,000 of Microsoft Corporation, and Harris intends to hold it for more than a year. So, if the company's intention is to hold it for more than a year, then we're going to have to classify that one as non-current, although it could go either way. Factory, non-current, right? You don't buy a factory and then expect to be done with it in 1 year. A factory is supposed to take, a factory will last a long time, certainly more than a year. So factory, non-current. Equipment, non-current. Patent could last a very long time, non-current, okay? Now, for balance sheet classification, type of asset. Let's categorize these same assets by current, investment, fixed, or intangible. And you're going to see this is pretty straightforward. If the duration is current, guess what? It's going to be classified as current. So we're going to just put an X in current for all of those. Stock investment, investment. Should be no surprise there. Factory and equipment are known as fixed assets. Fixed assets is just a category of things that you use in your business to produce other goods like property, plant, and equipment, building, machines, and so forth. That is considered to be a fixed asset. And then something like a patent or a trademark or a customer list, those items are considered to be intangible assets. Intangible assets are something that have value, but not something physical, not something you can really, wrap your hands around and hold on to. It's kind of an idea or a license or the trademark to be able to do something, etc. So that's how we're going to categorize these. Liabilities, okay? We're not going to get into a classification here. Typically, they're just classified between current and non-current. Accounts payable. It's expected you will pay your payables within a year or less, probably much less than a year, so that's going to be current. Interest payable, probably in less than a year. Legal fees payable, probably in less than a year. Those are current. Rent payable, probably less than a year. Note payable, it could go either way. In our example, our note was for 5 years, if I recall correctly. So if it's going to be a 5-year note, that's going to be non-current. If a note happens to be for less than a year, and it would say so in a problem or in a real-world circumstances, maybe it's a 6-month note, then it would be current. But in our case, it's going to be non-current. Mortgage, typically more than a year, so that's going to be current. That's going to be non-current. And of course, common stock lasts into perpetuity, at least theoretically. So that is going to be non-current. All right, so we have classified all of those. We accomplished that. Next thing we were supposed to do is record the closing entries, because this was a little aside where we did the classifications, but now we're going back to the trial balance. Once we have the trial balance completed, we have to post the closing entries. And if you recall from CRAM session 1, how do you record the closing entries? Well, you close out all of the income statement accounts, you close out all the revenue accounts to retained earnings, and you close out all of the expense accounts to retained earnings. Now, I'm going to do it 2 ways for you to see here. Okay, the first way that I'm going to do it is I'm going to do it in a column format. So here is the trial balance. We have the debit side, we have the credit side. Here is an adjustments column where I'm going to do this entry. Here we also have a debit side and we have a credit side. If here are our income statement accounts right here, starting with revenue right there. If the balance has if it's a credit balance, then I am going to put an entry on the debit side in the adjustments, right? Imagine that this is let's go back right here. Let's go back to services revenue. Let's go back to this T account right here. Here's a credit of 25. That's this credit right here. If I post an entry to 25 of 25 right here, and I have 25 and 25, what's the balance in this account? 0. That's how I zero this account out. That's how I close this account. Remember, we're closing the income statement to the balance sheet. Here I'm going to do it in a column format. So here's a credit, I'm going to put a debit. I'm going to put a debit for this one too. If it's a debit, then I'm going to put a credit. I'm going to make an entry. This would be the same. This is cost of goods sold. This would be the same thing as me putting a entry right here. 2,500 debit. I'm going to put a 2,500 credit right there. Okay, and I'm going to do it for all the expenses. All right. Then what I'm going to do is I'm going to swing over here, and I have an area here where we have the area for the closing summary journal entries. We're going to do it in journal format as well as on the table, so you can see the difference between all of them. So the first thing I'm going to do is I'm going to all of the revenue accounts. They have a credit balance, right? All revenue accounts have a credit balance. So the first thing I'm going to do is I'm just going to make a summary entry. Summary entry means instead of doing it account by account, I'm just going to do all of them. I'm just going to say revenue accounts. I'm going to say revenue accounts. And for that debit, I'm going to sum up this entry right here. Here's the entry that I just made. I'm going to sum up all my debits right there. And what is the other side of that going to be? Well, we know it's going to be 31. What is the credit going to be to? What account? This should be over here, debit. Retained earnings, that's what we're doing. We're closing this out to retained earnings. So we're crediting all the revenue accounts, and then we're putting that credit in retained earnings. Now we're going to do the exact same thing for the expense accounts. And before we go back to get the number, what is the entry going to be? Well, if we're closing the revenue accounts and putting it to retained earnings with a credit, then the income statement accounts have to be closed with what? Well, they have to be closed with a credit because, excuse me, did I say income statement accounts? I meant the expense accounts. I have to be specific. The expense accounts have a debit balance. They need to be closed with a credit. So we're going to put a summary entry here, expense accounts, and we know this side is going to be retained earnings. Okay, and then I'm just going to go over here and I'm going to sum up all of these credits right here that I just made to the expense accounts. All right, and I know that this number is going to be the same thing. So there's our entry right there. We have 2 entries to retained earnings, and from that, let's go over here. What do we know net income to be? Well, we know that it's revenue, okay, which is this number right here, and we know that it's minus expense. There's all our expense numbers. So I'm expecting net income when we get to the income statement. I'm expecting that to be $19,800 if we're doing things correctly. All right. We're going to get to the income statement in a minute, but this is a summary income statement that just shows total revenue minus total expense. This is what I'm expecting net income to be. Okay, and the last thing that we have to do before we can finish up our post-close trial balance is just to make sure we know what the balance in retained earnings is. We did the entries right here. We did the closing entries to retained earnings here, but we need to just make sure we're crystal clear on what the balance is. Here's a simple T account. We know that the opening balance is 0 because this is the first year that the company is in existence. If you recall, in our general ledger, I had said there's no T account there because this was the first year that the company was in operations. So beginning balance is 0. Increases, we know that is net income because revenue and expense are closed to the retained earnings account. So we know that increases are 19.8. There's no mention of any decreases anywhere in the problem related to retained earnings. So that gives us a simple summation of 19,800. Remember, a T account is opening balance plus increases minus decreases equals ending balance. So we have a 19,800 credit balance in retained earnings, and I'm just going to come over here and I'm going to just plug that in right here in the post-close trial balance because we know what that number is. For the rest of the accounts, I am going to do a very simple calculation. Remember when we were doing these adjustments a few minutes ago, I said this is very straightforward. Just imagine here's sales revenue. It's got a credit balance. I put $25,000 on the debit side. What's the balance now? 0. So that's the same thing we're doing in column format. Here's the 25,000 credit balance. I'm just going to throw in a debit of the equal amount. So this account should be zeroed out. This account should be zeroed out. This account should be zeroed out. It's the same thing as just putting an entry right here. Okay, we're just doing it in a column format. And so the way to do this summation here is very simple. I'm just going to say my post-close trial balance is nothing more than my pre-close trial balance. Okay, it's nothing more. This debit here is nothing more than this debit. Okay, less any credits that I happen to throw in the adjustments column. In the case where there are none, then the pre-close and post-close trial balance numbers will be the same. That's pretty straightforward, right? Same on the credit side. Whatever this credit was, minus any debits that I threw in. It's the exact same thing as the T account. It would be like saying the credit minus any debit I put in there. And if I put in the $25,000 debit in this account, the balance would be 0. So that's all I'm doing here, except in column format. And I'm doing that for all line items, right? When I say line item, I just mean like this. That's a line item. That's a line item. Except for retained earnings. Retained earnings, we calculated the balance over there. That's the only one I'm going to just plug in. The rest of them, I'm going to do exactly what I just said. And as you can see, for all the income statement accounts below the retained earnings line here, the balances are 0, as they should be, because the whole point here is I'm trying to zero these out and put it in retained earnings, which is what we did. Okay? Now, technically, I should actually put the balance right here. If this was in the real world, I would put the balance there too, to show that this is the adjustment, right? It went from 0. This started at 0, so I need something in this column to get over here. Okay, so technically I should have put it in there and then moved it over here. You will see when I do that also that the adjustments column now balances, right? Debits and credits have to balance. Debits and credits in the pre-closing trial balance. Debits and credits in the adjustments column, this is still debits and credits. They have to balance too. That's why I need the entry right there too, to make sure this balances. And with this here, then this balances as well. My post-close trial balance also balances. So everything is in balance. We're doing well here. All right, the last thing that we need to do then is prepare the income statement and balance sheet. We have our closing entries were done. Pre and post-close trial balance were done. All we have to do is prepare the two financial statements. So we were asked to prepare a classified income statement and a classified balance sheet. So let's just go over what that is real quick. What does a classified income statement mean? It means that if you have more than one line item within a larger category, that you will subtotal all the line items in that category and then put that total in the main column of the income statement. And when I do it in just a second, you will see exactly how that makes sense. Okay, and classified balance sheet, the first part means exactly the same thing, that when you have subcategories within larger categories, you will group them together. It also means that we will present assets and liabilities as current versus non-current, which we already know what those are because we over here we already classified them. We know exactly what's current, what's non-current, what these different classifications should be, so that should be no trouble at all. And then right over here, it means we will also group them by type, which is what I just said. That's part of this. This is the asset type. So let's get started building our classified income statement. So here it is. The first thing that is going to go on any income statement is going to be revenue. So we're going to put that there. And if you recall, we actually have two different kinds of revenue on this particular company. We have the services revenue and the sales revenue. So this is going to be what it means to subtotal. When you have multiple line items in the same category, we're going to subtotal them together. So in this case, we have this line item and this line item within the revenue category. So we're going to first, I'm going to go grab those amounts right over here from the trial balance. 25,000 was the first one, and 6,000 was the second one. Okay, and then I'm just going to put a line right here to show that we're doing a calculation, and then I'm going to sum these two numbers together to get a total. So that's where we're subtotaling multiple line items in the same category for purposes of the classified income statement and putting the total of those in the main income statement column. Let's call the rightmost column, we will call the main income statement column. And then we'll have this column here is for subtotaling multiple line items in the same category. And then we just want to identify what this is. So total revenue. Okay. Now after revenue on any income statement is going to come cost of goods sold. Right? That's always what's next. If you have cost of goods sold. If there isn't any, then that wouldn't come next. 2,500. So we're going to come over here. I'm just going to enter in 2,500 for that. And actually, I take that back. I'm going to take that out right there. I don't have multiple cost of goods sold items. So I only have one. So if I only have one, I'm actually going to put it over here in the main column. I only need to subtotal them if I have more than one. After cost of goods sold comes a category called operating expenses. And within operating expenses is going to be all of these other items. So let me go over here and grab them. We have the legal fees, we have rent expense, we have interest expense. So I'm just going to link those descriptions right over here and drag it down. And then I'm going to go into my subtotal category. I'm going to then slide over here. I'm going to grab the amounts of my legal fees, and then I'm going to just slide these down right there. And then I'm going to put a line to show that we're doing a summation here. I'm going to sum up these and get a total right there. And then the last line, we have to identify what this is. This is total operating expenses. And then the last line, that's everything we had on our income statement. So the last line will be net income. And when we take, now remember, on an income statement and a balance sheet, on the financial statements, we don't have the numbers positive and negative. We don't have negative signs. So you have to make sure to do the math correctly. So it's going to be this one, it's going to be minus this one, and it's going to be minus BN24. For some reason, Excel won't let me grab that. All right, so 19.8. It's this number minus this number minus this number. 19.8. Let's go back up here to what I thought it was going to be. 19.8. So this is like a quick income statement. All my revenue, all my expense, net income. This is a classified income statement where I break it out so that financial statement users can see all the detail. They can see where the revenue comes from. They can see what the different kinds of operating expenses this business is subject to are. So the classified income statement in total provides the same information as just doing a quick calculation right here in total net income. But as far as detail, financial statement users like to see this kind of detail so that they can assess the health of the company and whether they want to invest in the company and a variety of other things which come later in accounting. Now we're just working on preparing these financial statements, okay? All right, so the income statement is done. We got this one. Now, the last thing we're going to do is we're going to prepare a classified balance sheet, all right? And the first thing that's going to be on any balance sheet is going to be assets, which I have the category there. So recall here our different classifications. We basically have current, I'm not sure why you can't see that right there, current, investment, fixed, and intangible. We also have a breakout between current and non-current. So how are we going to set this up? First thing on the list is going to be current assets. All right, and then what I'm going to do, since I have multiple current assets, we're going to have to subtotal them. So I'm going to go right over to my trial balance. I'm going to grab the listing. I'm going to go 1, 2, 3, 4. I have 4 current assets. Does that match what we did earlier? 1, 2, 3, 4. It does. Okay, so we identified 4 current assets: cash, accounts receivable, revenue receivable, and inventory. And since we're doing a classified, I need to subtotal, so I'm going to go into the left column. Then I'm going to go back to my trial balance. I'm going to grab the first 4 balances on the list right here. Then I'm going to put a line here to show we're doing a calculation. I'm going to go ahead and sum these 4 up, and we're going to get a total here. And then I'm going to identify what it is by writing total current assets. All right. After that, we have the next category, which is long-term investments. All right. Long-term investments. Now, in this case, we only have 1, but I'm still going to put the broad category there. We have stock investment. Okay. And the stock investment value, since there's only 1, I'm not going to do any subtotals. I'm going to put that directly over here in the rightmost column of the balance sheet. I'm going to grab it right from there. Okay. The next category we're going to have is fixed assets. Okay. And what we have there is, let's see, we have 2. We have factory and we have equipment. So I'm going to do a subtotal for those. I'm going to put them right here. I'm going to go over here. I'm going to grab my factory and equipment. I'm going to put a line here to show that we're doing a calculation. I'm going to go ahead and sum these up and get 50. And then the last category is going to be intangible assets. And we have 1, I believe, which is the patent. And that value is going to be 8,000. So I'm going to just stick that directly into the main column of the balance sheet. And there we go. And so this right here would be total assets. Actually, you know what? I forgot to write the identifying what this is. We have to identify what this total is right here. I left that one off. So this is total fixed assets. There we go. And then we're going to drag that down right here. And we're going to drag this down right here. And this is where I'm going to put in my category, assets. All right. And if we then sum up all of those, we're going to have 132,500. That is going to be our total assets. Now we're going to do the liability section, and we're going to see if that balances. So the first thing on the liability section is going to be current liabilities. And then we're going to go over to our trial balance, and we're going to grab all the current liabilities that are on there, of which I believe we have several. Starting with accounts payable, 1, 2, 3, 4. We have 4 of them total. Okay, so I'm going to go here. I'm going to drag this down 4. There's all of our current. I'm going to go to the subtotal column. I'm going to go back up here. I'm going to grab my balances, starting with that one. I'm going to drag this down. I'm going to put a line that we are doing a summation. I'm going to add these up. And then after that, I am going to identify what this number is. It is total current liabilities. All right, and after total current liabilities, like I mentioned, they don't do too much more categorizing. We're basically going to have non-current liabilities. All right, there's not quite as many buckets typically as there are with assets. So I'm going to go back to my trial balance. I'm going to find my non-current liabilities, which are starting with note payable. Right here, I have 2. I also have the mortgage payable. So I'm going to go here. I'm going to go to my subtotal column. I'm going to go back to the trial balance. I'm going to grab my note payable, and then I'm going to put it there. I'm going to put a line. We're going to do a subtotal. We're going to add these up, and we're going to have 70,000 there. And then I'm going to write total total non-current liabilities. All right, and the last category then is going to be shareholders' equity. And I believe we have 2 kinds. We have common stock. Common stock is an equity account. We also have retained earnings, right? Where's my common stock? Right here, and there's retained earnings right below it. So I have my common stock and my retained earnings. Now for those, I'm actually going to have to go and grab those off of the post-close trial balance, because the retained earnings isn't on the pre-close trial balance, is it? We had to close that. So there it is. I'm going to put a line. I'm going to sum these up. I believe I can just copy this and put right here. That'll grab the sum. It will. All right, so now I have my total stockholders' equity. All right, and then what we're going to do is we're going to add up this one plus this one plus, oops, no, I do not want to accept that, plus this one right here. And 132.5 is my total liabilities and stockholders' equity. Total assets, 132.5. My balance sheet is in balance. So both of those are the same. Okay, so that was everything we were asked to do on this page. Let's quickly just go through the entire process high level one more time. Number 1, financial transactions. Number 2, journalize each one of those financial transactions to the general journal. Once journal entries are journalized, then post the entry from each journal entry, each line, into the general ledger. Then sum up both sides of each account. Subtract the smaller number from the larger number to get the balance. Once every balance in the general ledger is determined, then you go over here. You create the trial balance. Make sure it balances. If it doesn't, go back and figure out what you did wrong. If it does, we keep moving. The next step is to do the closing entries. I did them in two ways for you. One, we did them here in journal entry format. Two, we did them in column format. The point is to zero out the revenue and expense accounts, which is what we did, and determine what the ending balance is in retained earnings is, which we did over here. And then we can use those adjustments and that ending balance in retained earnings to calculate the post-close trial balance. After we do that, we can prepare the income statement and the balance sheet. Income statement if classified. If a classified income statement and balance sheet, it means you're going to use various categories. If you have more than one line item in any category, you subtotal it in the left column and stick the total in the main column or the right column so that financial statement users can see more detail. Same thing in the balance sheet. Assets are certainly classified between current and non-current, and they're often categorized between current, long-term, fixed, intangible, and so forth. Liabilities tend to be broken out just between current and non-current. You want to make sure that your balance sheet is in balance. You want to make sure that your pre and post-close trial balance is in balance. You want to make sure that your adjustments are in balance. All of this is debit and credit. All of this is double entry accounting. And when everything is in balance, then it works out quite nicely like we have here. And so that is going to be the end of this assignment. And starting in the next video, we're going to move to the next part of this cram session.